Hello, I hope you had a wonderful Thanksgiving and happy holidays. So here we are, it's time for the sausage to be made. If you've been watching the news this week, you probably know that there is a tax reform bill on the table in Washington. And just like with all things in Washington, there is a great deal of negotiation going on, a lot of back and forth, and this will be interesting news probably for the next few weeks. But where things stand as of right now, the House of Representatives has passed their version of a tax reform bill. There is also a separate Senate version of the bill, which is a little bit different from the House version, which is being voted on this week. There has been a lot of debate in the Senate. There are a few Republican senators who have been holding out because they have some problems with some of the terms of the new bill. Although yesterday, it appears that the negotiations took a significant step forward, and the odds of some form of a combined bill being passed this year seem to be rising. Just like sausage tastes great once it gets on your plate, even though it may be ugly when it's being made, we have a perspective that this bill is likely to taste great, even though the negotiations can be a little bit ugly. So we thought it might be a good idea just to give you a flavor for some of the high-level implications that seem to be in common in both bills and seem to be themes that you're likely to see with the approved bill. So the first thing that's important to know is that it's likely that the bracket system, the income tax bracket system, is likely to change. And this is going to be something that will impact all Americans. The House version of the bill condenses the brackets to just 4 brackets. The Senate version keeps the greater number of brackets, but in both cases, what they're looking to do is to have the tax rates in every given bracket kick in at higher income levels. So, for example, at the highest income tax bracket, which today is 39.5%, and today kicks in at right around $400 and change thousand in income, both bills call for the top tax bracket to kick in not till $1 million in personal income. So the odds are that pretty much this will be a tax cut for pretty much all Americans with respect to the average rate they pay on their taxable income. Although there are also changes in tax deductions, which may likely perhaps offset some of that for some Americans, or even enhance it for some. But the tax deduction changes are likely to be what may be important for you. So a couple elements of that. First, the likelihood is that the standard deduction is likely to increase, which will be an incentive for people to no longer itemize their deductions, but instead just take the standard deduction. Although probably most people in this audience will still continue to itemize their tax deductions. So some of the changes to itemized tax deductions that will be important for you. The first and probably most important is that seems to be in both sides of the Congress a call for elimination of the deductibility of state and local income taxes. So meaning you will no longer be able to deduct your state income taxes on your federal income tax return. The logic behind that is that the idea is that low income tax states are really subsidizing higher income tax states, and that's not fair. As a political sidebar, this is one of the really interesting debates that will go on with this tax bill, because if you think about it, most of the higher income tax states tend to be Democratic states, while the lower income tax states are Republicans. So you can clearly see that the Democrats are very much lining up against this bill, particularly this provision. But for you, what it means is the likelihood is you will no longer be able to deduct your state income taxes from your federal tax return. There is also some discussion of no longer allowing property tax deduction against your federal income taxes as well. Although the Senate version, there is some talk that might be restored. There was one senator who really felt that this was needed to be kept, and that was one of the concessions yesterday, that it may appear that property taxes will still be deductible. So that's something to watch out for. Mortgage deductions are likely to be changed as well. And this is something that's important for a lot of people. And the primary issue here is the reduction of the maximum amount of mortgage interest that you can deduct. Under current rules, you are allowed to deduct the interest on up to $1 million in mortgage interest. Under the new rules proposed, that number will now be $500,000. So there'll be a significant reduction in the ability to deduct mortgage interest, although existing mortgages on the books will be grandfathered under both bills. So the likelihood is that if you've already got a mortgage, you'll be able to continue to deduct that interest as you do now. There was some concern that charitable deductions would be eliminated. That does not appear to be happening. As a matter of fact, it seems that the likelihood will be that the limit on charitable deductions is also going to be changed. As it is today, you can only deduct charitable contributions up to 50% of your income, and there's talk that will now be increased to up to 60% of your income. So charitable deductions may become more valuable. For many, there is this annual Ouija board exercise of trying to figure out your alternative minimum tax. I will not even try to explain how the alternative minimum tax works because it's incredibly arcane. But if you're in alternative minimum tax, you know it because it basically means that you just have to pay a higher tax rate. Both bills call for the elimination of the alternative minimum tax, which I think would be a wonderful thing. There's also important provisions for those who receive pass-through income. So people who receive income from S corporations or LLCs. The discussion is that income from LLCs will be reduced dramatically to a maximum tax rate of something like 25 or 30%. Although personal service LLCs, accountants, financial advisors, lawyers, people whose own personal efforts contribute to the income of the LLC, that income will still continue to flow through at your regular tax bracket. So no relief there. So the primary implications from an income tax standpoint are, generally speaking, you're likely to be at something of a lower income tax bracket next year than you are this year. So it's probably better to postpone receipt of income or revenue into next year as opposed to this year. And your deductions, particularly your state and local income tax deductions, are more valuable this year than they will be next year. So there may be an opportunity to prepay or to pay up any state tax liability that you can in this calendar year while you can still use those deductions. There's also important estate tax implications. So the primary issue here is that the personal estate tax exemption is being raised or is likely to be raised to $11 million per person. So what that basically means is that for a couple, your estate up to $22 million in assets can be protected from estate taxation. So what that's likely to mean is that estate taxes will really only be an issue for the very ultra wealthy. And in the House version of the bill, in 2024, the estate tax actually goes away altogether. The real primary implication that is not being discussed and that doesn't really have anything to do with your personal tax return, but that we are really excited about, is that there's a call for the reduction of corporate income taxes from 35% down to 20%. So, of course, that's not likely to impact anybody's personal W-2 or personal tax return this year. But what it is likely to do is to provide a huge stimulus to the economy and particularly the stock market. So if you think about that, almost a reduction of almost half corporate taxes, what that's likely to do to corporate profits in this country and therefore stock prices, we're very excited about. As some evidence for that, yesterday afternoon, when it appeared that there was a breakthrough being made in the Senate and the likelihood was rising that the bill would be passed, the stock market took off like a rocket ship. So we are excited about that. We think it's constructive and positive for economic growth and for stock market performance in the future. Of course, time will tell as the sausage is being made. Turn on your TV and you're likely to see some entertaining discussion in Washington. We will, of course, keep you posted. And most of all, we hope you have a wonderful holiday season. Thank you.